Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to another episode of Honest Money. Today is going to be an interesting episode for me specifically because, we've had a heck of a lot going on in the world, the world economy. We've had a lot going on in South Africa, whether it's, load shedding, grey listing, all of that stuff. And the kind of the mood is not optimistic, let me say. And I think it's important for us just to get a bit of context as to what's going on. And for me, although I kind of grew up in the world of shares and stock markets, we always knew that, shares were the little part of the world and the big part of the world was the bond market. That was the thing that instilled discipline in the way that the world of money works. The bond market is the thing that gets prime ministers fired. Just ask Liz Truss. And so I thought, let's get some perspective. So we're bringing in one of the heavyweights in the bond world, Reza Ismail from he's head of bonds at Prescient Investment Management. Reza, thanks so much for joining us.
Thanks very much, Warren, for that very generous introduction. But pleased to be chatting to you. It's a pleasure.
So Reza, it's easy to get stuck in the world of predictions and forecasts and kind of get too gloomy or too optimistic. I think it's a little bit tough to be too optimistic right now. But when we look at the financial position of our country right now, What does it sort of feel like for the next year? What does it look like for us?
Yeah, it's an interesting question, Warren. Thanks very much. So, I'll circle back to this a little bit later, but the reality for the South African economy is that we actually face with an incredibly weak environment of aggregate demand. So what does that simply mean? If you think of GDP or the growth of an economy, 60% of that is broadly represented by households, right? So what ordinary households are doing and the general health of households. Now the problem now that you have is that you've got a plethora of things that are actually cutting against the spending health of households. I mean, one of them is obviously the prospect of an unsupportive and unstable energy grid, right? So, companies are cutting down on hours. That means that they need less employees. The amount that they produce shrinks, and so you find that unemployment is actually moving in the wrong direction. Then you have inflation, right? So inflation, if you think about a basket of goods that an average household will buy, that's become a hell of a lot more expensive, right? So that's another shot from another angle, right? And then you think about the global environment, right? South Africa, as a relatively small emerging market economy, is but a small cog in a giant machine. The bigger cogs there represented by the likes of the US and China. I mean, it's been an incredibly volatile year, with policy normalization in places like the US, in Europe. So that has also led to a hell of a lot of volatility and a lot of risk aversion. So you've had capital flows flowing out of emerging markets into perceived safe havens like the US. So from a number of fronts, it's an incredibly challenging environment for the South African economy, not least of which is the consumer that is facing, a whole arsenal of challenges, right? But the reality is we are actually sitting in an environment where aggregate demand or the broad, sort of pulse or heartbeat of the South African economy is very weak, right? There's no getting away from that.
And are we sitting in a position? So just if I try and follow that train of thought, it's not our job to sit here and just always be optimistic for the sake of optimism. We need to be real about what's happening with our money so we can make smart decisions around our money.
Yes.
And so listening to you now, that's not a great picture. And then I guess the follow-up question to that is, are we staring kind of a collapse of the country? Is that what we're looking at, or is it kind of is it a cycle where things are able to turn again, or are we on a downward? Is this it? Are we on the slippery slope to nowhere? How do we navigate this? We can't make 10-year predictions. No one can. Those are just nice bedtime stories. But just right. Listening to you and looking at the numbers, are we in a position where there is just compounding bad news and we need to plan accordingly?
Yeah, I mean, look, it's tempting to say that, look, we are on a slip, as you say, a slippery slope to nowhere, right? And we've in fact sort of gone over the cliff, and it's now just waiting until we hit the bottom, if not there already. There are a few green shoots, I would say. I mean, we know that for a while the talk has been that sort of to get South Africa back onto a redemptive path, let's just say. There are a number of structural reforms that need to be effective, right? The first one is obviously the obvious one, is getting a stable and reliable energy sector, right? There have been some moves in that direction, but until you have businesses that are able to say, I can plan for capital expansion because I'm certain that I'm going to have a sufficiently stable energy grid, right? Until we get to that point, right, we're still going to be in the doldrums. So structural reforms, the first one is that securing a reliable energy grid, okay? The other one is, and that in turn speaks to the second one, is the return of business confidence, right? So business confidence also is probably, almost like an all-time low, and we can proxy that by looking at, certain line items in the balance in the budget document that speak to capital formation. So firms are simply saying, I own a pizza factory. There's not a chance that I'm going to build a second pizza factory because I simply don't know whether I'll have power and those kind of things, right? So business confidence needs to return. And then the third thing is that, I mean, we suffer from chronic unemployment and from a chronically small sort of, let's call it, educated middle class, right? So unless we address getting grassroots level education, addressing, making sure that people are in schools, making sure that you have functioning schools, those kind of things, that needs to gradually feed through. Unemployment needs to go down, and you basically just need, let's call it, a more literate and a more mobilized middle class in order to start seeing some of those reforms. So some of these things that I mentioned there are somewhat low hanging. They can be addressed within, let's call it, a sort of a 2 to 5 year window, and some of them a little bit more longer term. Speaking about the thing which I mentioned in the beginning, one of the green shoots about one of the sort of the headwinds that household faces is it was around inflation. You remember that that comment, but one thing about that is that the inflation in South Africa is largely driven by what's called administered prices, right? So inflation is not sort of like demand driven simply because households are buying oodles of things and that's pushing up prices. That's not really that. It's largely that you get inflation because of extraneous things like electricity and like the oil price. Now many of those things have led to high inflation over the past 18 months, but many of them are now abating, right? We're going into a period in which certainly oil prices have come down. Relative to where they were. Food, agricultural produce, the prices of those things are also coming down, right? Albeit at a slow pace. So you'll find that at least one of the things, or one of the headwinds that consumers have faced, will abate in the near term. I mean, so that's a little bit of a reprieve. And then, as I say, there are moves afoot to address energy, to address unemployment, and to address grassroots level skills transfer. So those things, if played correctly, can take us out of the doldrums and hopefully onto a more stable, real growth path.
And I think it's an important point there that some of the things are there are massive problems, but they're easy to see, and actually, I'm not saying easy to solve. I mean, big problems are never easy to solve, but a few levers can be pulled that can have a huge impact on switching direction. And neither you nor I are sitting here and saying yes, they've been pulled and everything's going to be fine. We're just saying they can be pulled. They're there. We know what they are. Please pull them, and we'll be better off.
Absolutely.
So maybe let's just get to some nuts and bolts around the budget specifically, and because with these economists, they always use a lot of jargon, and so for me looking at this, the one thing I thought is there was something that didn't make a lot of news, and that was in the world of personal finance. When you have 100 Rand coming into your bank account every month, and you spend 101 Rand every month, that's a bad sign. That means that your debt is increasing, and you're just getting into worse financial position all the time. One of the
Yes.
little things that I don't know if you agree, but it felt to me like it didn't get a lot of news was that now it seems like coming up in the next couple of years, we're going to be earning $100 and we're going to be spending, let's say, $98 every year as a country, except for the part that we need to allocate for interest. So actually, we've stopped digging the hole deeper, bar for this huge interest burden we've got. And I don't know what they call it. I can't remember what that is now, a primary surplus. I can't remember what the phrase was that they use. But that we haven't done for quite some time as a country. We've been spending much more than we earn every year. Forget about interest.
Absolutely, yeah. So this is actually the first time since around 2009 that we've registered a primary surplus, right? So as you say, if you just look at basic revenues and basic expenses, basic expenditures outside of debt servicing costs, then yes, then I mean it shouldn't really be sort of like a championing thing as that you've achieved something, but there is more money coming into the household than what is leaving in the form of expenses, yeah. But in truth, I mean, whilst this is an achievement of some sorts, but one needs to focus also on the consolidated budget, right? And that's actually where you do have a deficit, simply because debt servicing cost is such a big part of the story now, right? So you have now the situation that on the consolidated budget, you're sitting with a deficit now of around 4%, right? So what that roughly means is that we get the government gets revenues in via tax receipts. Ordinary people pay taxes, corporates pay taxes, a number of those things, and then it's got expenditures. It's got to pay nurses and teachers and all of those things, the social wage stuff, right? And then also it's got to service debt, right? So now what has happened is that we've slightly outperformed the number that was so that deficit is sitting. You can think of a deficit as a basic overdraft that needs to be financed somehow. So that's sitting at about 4.2% now on the recent budget. That was about 4.9% at the time of the MTBPS. That's the medium-term budget policy statement that happened towards the latter part of last year. So we've actually outperformed that, right? But if one digs a little bit deeper, and just to dovetail this with the kind of comments that I made a little bit earlier on, this phenomenon actually, might falsely give the idea that we're sort of doing okay and we've sort of exceeded our expectations. But what is really sitting there is really certainly relative to history, very, very high mining tax receipts. So last year, if you remember, was actually a bumper year for commodity prices, right? So we happen to be one of the kings in terms of PGM metals, like that platinum group metals. So things like platinum, palladium, rhodium, and those types of metals, right? So those are very important because they're very important for all this talk about energy transitions, right? They're used in cars to clean emissions and things like that. So last year was a fantastic year for PGM miners. There were a fantastic year for a range of base commodities. And because of this, miners had a boom, right? So miners did very, very well last year on the back of high commodity prices. And because miners, are relatively well run and well regulated, all of those corporate tax receipts found their way back into the government kitty. But it's not because the average mom and pop is actually doing well. It just happens to be that it occurred at a point in time that commodity prices were very high and miners did splendidly well, and they were able to plow some of those corporate tax receipts into government coffers, and that made us be able to sort of outperform what happened relative to the MTBPS. But it's not in any way an indication that ordinary households are certainly in better shape than what they were relative to let's call it October, November last year.
I'm going to work really hard in this podcast to get you to say something good, positive and optimistic by the end of this. But I do. So I take the point, and I think it's fair. It's fair. I mean, we can't just be a Pollyanna with the rose-tinted glasses and saying everything's fine. But what was noticeable to me was that SARS is doing a better job every year in collecting more of the tax, even though there was the bonus of the mining sector. I'm on your page. I agree with you. And I guess maybe the follow-up point to that is That's not guaranteed to happen this year or the next year when we get another commodity boom. So we have to be aware. We've had some luck. I'm also comforted that maybe we're using that luck a little bit to kind of try and make a bit of a dent on debt. But there, I think the Edward Kieswetter said that for every extra 80 cents we give SARS in terms of budget to collect more money, he can collect $100. And that's material, and that's so the fact that SARS has got whatever it is going to be, I don't think they gave us the number, but let's just say he gets another $1 billion, then we're going to get a lot more tax revenue because 30% of the money that should be collected at the moment isn't being collected. I think it's 30%, but I think that's that is a new kind of positive trend for me, that SARS is doing an increasingly better job year after year after year. And the dodgy businesses that have been dodging tax for quite some time are realizing we're going to get caught.
Right.
We have to pay our tax.
Now, Warren, that is absolutely spot on. And the technical term for that thing is called tax buoyancy. So tax buoyancy means it's the ratio of how much tax revenues grow by over the amount at which the economy grows by as a whole. So it's tax revenues, percentage change in tax revenues over the percentage change in GDP, let's just say. So if GDP, just by way of example, if GDP goes up by 10% and your tax revenues also go up by 10%, then you've got a tax buoyancy. You've got basically, then that figure is 1, right? Because you're matching growth in tax revenues on a 1-for-1 basis with whatever happens to GDP. That's a good thing. Now, as you say, there were some dark days in which there were some, let's just call it institutional failings at SARS, right? There was a whole range of very abnormal things happening there, and during those dark days, that tax buoyancy, what I've just been speaking about, that almost went, to shockingly low levels. In other words, even though we managed to eke out some real growth in the denominator, what wasn't happening was that for some reason there was this wide range of slippage that was happening, that meant that even though we had growth at an overall country aggregate level, but it wasn't for some reason finding its way into SARS's coffers, right? That just simply wasn't happening. So what has now happened is that, there's obviously been some, let's just say, some changes that have been made there. But now evidently it is the case that tax buoyancy, that metric has improved. And for a given level of growth in the South African economy, we are seeing much better tax revenues, right? So this is more sophisticated methods of collection. That's A. More sophisticated methods to detect when people are actually trying to run foul of the law, right? By various ways and means, and sometimes there was dodgy stuff, right? Right. So there's much more sophisticated ways to weed those kind of things out, right? And the reality is we actually have a very small tax-paying base here in South Africa, right? We actually have a very small, that is the reality, okay? So it actually means that if you actually address certain big hitters, right, in the corporate space that have actually been, running foul of things for a number of years, if one actually addressed, I would say maybe less than 50 of them in the corporate space, right? And that 50 is a small number if we think of big corporate. If one just addressed the dealings over there at 50 selected corporates here, that could make an enormous change, to the amount of taxes that get received, right? And SARS is well on the path of basically trying to address that there are certain sort of known sort of big hitters that one needs to actually address with regards to their tax performance, right? So that is getting done. That's one good thing.
It is one good thing. Thank you. I've got it. I can sleep tonight. And maybe the other thing there is we didn't see a tendency from SARS, or not SARS, sorry, from Treasury to raise taxes. I felt that it wasn't said, it wasn't explicit. It almost felt to me like a sentiment was, if we get a bit of economic growth, we'll do our best to try and moderate taxes. Actually, we don't want to increase tax. And I feel that that's a lovely trend if it sustains.
Absolutely. And again, again, tying this to a little bit of theory, that again speaks to something that, studied at campus and whatever, called the Laffer curve, right? So what that means is that it means that you can't, it's not going to be the case that if you you sequentially just increase tax rates higher and higher and higher, that your actual tax receipts will be higher, because it gets to the point where Joe Soap is an ordinary tax-paying citizen, where he realizes now that actually no, tax rates are so punitive now, I might as well actually pack up shop and go somewhere offshore, right? I might as well relocate to New Zealand, or I'm just mentioning these names anecdotally, or to another place that's got a more favorable tax jurisdiction. Like, that's what happens. So actually hiking your tax rate too much actually can find you that you encroach and you make smaller your tax base. So it's not a simple sum as saying I want to collect more taxes and therefore I'll just hike rates to infinity, and I'll get more tax in it. So it doesn't quite work like that. So they've tried to find a happy medium by saying I'm going to keep taxes at a particular level and improve collection methods. Weed out the guys doing a little bit of dodgy things, and that will mean a much bigger delta for government revenues.
And so maybe just to stay on that point for a second, it feels to me a level of sophistication that wasn't there before in the understanding of finances and treasury. In other words, actually, if we get some breathing room as treasury and we drop the tax rates on individuals or on corporates, and politically, I feel like, and it's my comment, not yours, but I feel like it'll probably be easier to drop the corporate tax rate than it will the top marginal tax rate for the rich. But if we drop the tax rate by 1 or 2%, actually the country might make multiples more in revenue, because more people feel they're getting more value. That's easier for them to comply than to start trying to dodge taxes. And I think it feels to me like a trend. I think we're using up our time, and I need to talk to you about this big move, which was the thing that really I wanted to see in this budget, which happened was government saying we're going to take a chunk of the debt away from Eskom because it's impossible for Eskom to actually deal with this level of debt. It will not be able to do anything, and government's going to take it on. The details and the mechanics may be not so relevant for now, but number one, that it happened, I believe is a good thing. I hope it's a good thing. But maybe, what does it actually mean? Like, have we taken debt off Eskom to make it a little bit more sustainable than it was financially? But have we now absorbed the debt as a country, and now we've gone over the edge? Now we're unsustainable, or can we deal with this debt that we've taken on at a national level?
Sure. Warren, let me just give a bit of an intro into this answer, right? So, look, a lot of this discussion was perhaps sensationalized somewhat because of the fact that people can be forgiven for not working too close to the debt markets. But what actually happens here, Warren, is that most of the stockpile, the debt stockpile that Eskom had, right, was government guaranteed in any case, right? So what that simply means is that Eskom issues some paper, they issue a bond, and if investors buy the bond, and the bond says, I'm going to pay you interest, I'm going to pay you coupons every half year until the bond matures, and then you'll get your principal back, okay? That's a normal. Now, let's just say Eskom finds itself in hot water and says, sorry, chum, I can't actually service your debt anymore, I can't pay you. Then because it was government guaranteed, what would happen is Treasury would then step in and service that coupon on behalf of Eskom because it was government guaranteed. So now it was almost National Treasury's problem in any case, if you think about it. Like, now they're simply saying, I am formally going to give you some money now to help you to service debt. And that's actually what this act really entails. It is essentially the South African Treasury via the National Revenue Fund that is saying to Eskom, look, my friends, I know you're in hot water. I know that you can't do maintenance and you can't fix things because a lot of your money is gone into debt servicing. So I'm going to give you some money directly that can only be used to service debt and to service, maturing instrument to service principal for no other reason, right? For no other purpose can you use this money. So what will happen is there will be, over the next 3 fiscal windows, totaling about 184 billion, there will be these little tranches that will be paid over to Eskom with significant conditions attached to it. So the idea here is that you almost give them upfront some money that they can say, okay, you guys must use this to help to pay down your debt. It will give you some breathing room, and you can use your actual revenues that you normally get via people paying for electricity and that kind of stuff, you can use those revenues for servicing your plants, for breakdowns, for improvements, for those kind of things. So that's really what it has amounted to. What does it mean for the balance sheet? It means that, look, usually the South African government, the Treasury, needed to take into account failing SOEs as what they refer to as contingent liabilities, right? Something that is not strictly supposed to be there, but the reality of the world is that we've got to give these guys capital injections at every budget. That has been a trend. So now what has now happened now is that they're saying, but when you give those capital injections, that's almost like an expense for the Treasury. So what this is now done is that it's not an expense per se. They are now formally giving money for the purposes of servicing debt, and it forms part of the financing side of the balance sheet, right? It's on that side, on the debt side, and not as an expense per se, like a direct equity injection would be. So to just take something very, very basic away from what I've just said, there will be a period of 3 fiscal windows, 3 years, until the 2025-26 fiscal window. The Treasury will make available certain pots of money to Eskom that they can only use for helping to service and pay down debt, right? They can't use that, importantly, they can't use that to develop more generation capacity. In other words, if for example, they had 20 firing units, let's just call them units, right? And now 4 of them have become obsolete. Now they've got only 16 firing units. They can't use this money from Treasury to reinstall those other 4. That's now gone, right? You can't. And gradually, the idea is that they lessen the reliance of to Eskom as an energy source, as an energy producer. And the idea is that there are some private partners that can come into the space, and in so doing, over time, to decrease the reliance on Eskom as the sort of national energy provider. So that is broadly the idea of what they've done. It's not a very seismic move, Warren, but it does signal intent, and it is a move in the right direction, right? As I said, there's a lot of conditions attached to what they must do. They must have a quarterly meeting with the Minister of Finance and report on exactly how they've spent the money. So there's a lot of conditions attached to it, but I do believe it's a move in the right direction.
And it feels to me, that it's not those conditions are really necessary. And for you and me as taxpayers, what we know now is, yes, the debt is too big. Yes, it was, corruption that caused all this stuff. But right now, the financial director of the country is saying, I'm going to give you more money, but I want to know exactly how it's spent. It's not a blank check. The scope for corruption is much less.
Yes.
You're going to use this for disciplined financial behavior.
Absolutely.
The money that you then get, because I think that's equally the point, right? He's also saying the money that you are receiving, I'm also telling you where you may spend that, not just the debt I'm giving you. You need to now, act like grown-up business people here and act like a grown-up utility, and there's no more blank check, bad behavior. We now deal for the country, for what it should be done.
Exactly. That's absolutely right. And if we just think about this in simple microeconomic terms, Warren, right? If you have a town, right, and there's only one little hut, or there's only one little shop in that entire town that is making bread, right? It's impossible for that little hut to run at a loss, because you are in a monopoly, right? So Eskom is the only monopoly in the world that runs at a loss, right? You essentially, by definition, you've got a captive market. We need to buy electricity only from this one place. Okay, it's moving slightly now. A little bit of people installing generators and solar and all of those kind of things, but that's a very, very small part of the everyday reality. Eskom, for all intents and purposes, is an energy monopoly, right? So it is almost like quite absurd that you should have a situation for a monopoly to be in such a cash burning, to be in such a non-profitable financial footing, right? And there needs to be drastic steps to address that. It obviously cannot happen overnight. There are still some significant headwinds, but this is a step in the right direction at least.
It's the second big positive thing you've said for us today. Thank you. So Reza, we are. I think this is going to be our longest podcast in Honest Money, which tells me that it was really interesting. And I need to ask you one more question, which is my favorite question for all new guests. If you were to meet the 21-year-old Reza now, with the benefit of the time and experience that you've had, what would be the one life lesson you would love to impart to him now? It obviously, this is the Honest Money show. It can be a money topic, but if it's a life lesson that's not related to money, equally, what would be the one thing you'd love to teach your 21-year-old self?
Okay. So there are a couple of books that have made reference to this analogy I'm about to give you, right? So Warren, if you the idea is this idea. It's a big word, but it's called time arbitrage. What does it mean? This is what it means, right? It means that if you were to take a coin, an ordinary fair coin, right? It's got heads and tails, right? And you flip that coin, got a 50% chance of landing on heads, 50% chance tails, right? Okay. Now what happens is I flip this coin 10 times, okay? And let's just say that all 10 times it lands on heads, right? What's going to start happening, and let's just say, for argument's sake, I'm doing this in front of a crowd, right? What's going to start happening if the first 10 flips all land on heads, is that the crowd is going to start to think that there's something wrong with the coin. Although that is a perfectly statistically valid thing to have happened, that you just happen to have, the probability of it happening might be small, but it can happen for a fair coin. It can happen that you flipped it 10 times. But what the market will start doing is will think there's something wrong with that thing, and they will basically start getting away from the little game that I'm there to show. Now, it's the same thing, Warren, when you're talking about investments, right? Sometimes certain things behave in particular ways, and sometimes they behave in particular ways that for very long periods of time, and basically invite disfavor. Think about a share or a stock, a share, a bond, a currency option, any asset that you like, right? Sometimes it can happen that particular characteristics about that, the way it's trading, the fact that it's made losses, can actually invite an excess of pessimism into that stock or bond, right? But as long as you've done the homework, like for me, I knew that being a fair coin, at some point I will get a tail. I will get a tail because there's nothing wrong with the coin. It's a proper coin. There's nothing wrong with it. So in the same way, if you've done due diligence on a particular company, you've done the homework, right? Then sometimes it doesn't really matter what amount of pessimism and how many people are walking away from it, whether it's a stock or a bond or a currency option or a basket of shares. It doesn't matter, right? You must be prepared to actually say, I've done a little bit of homework here. I know the moving parts here. I understand this asset well. I'm not really going to take notice about what's happening externally, how many other people like it, or how many other people, I'm going to put my money here, right? So I would say that try to filter out, and it can happen on the upside and the downside, excess optimism and excess pessimism. But particularly I find it's with excess pessimism. Particularly I find that if you can understand something and realize that there might be times that this thing is going to be met with excessive pessimism, that might be a time to increase my exposure to this thing, and over time that's a great strategy. Now Warren, you can extrapolate and you can place this little analogy on almost anything that you like, but it just circles on two main points is that I could tell my 21-year-old self is do your homework, get to know and get to understand an asset that you are interested in. Once you've understood it, don't take notice of what's been priced to that in terms of things that get excessively pessimistic, right? If you know what an asset is worth, take a position, and like I say, just let the time play out, right? That is that more or less. It will be a very long conversation with my 21-year-old self, but to explain this whole analogy to him. But that is essentially the core of the message. That's the core of it.
It's so. I love that message. Thank you, because it's so timeless right now. We're sitting in our country. I think you're sitting in Cape Town. I'm sitting in Joburg, where the traffic lights don't work in load shedding. Well, that's when the traffic lights are working, and potholes and the like. And it's easy to lose sight of that. We are a country of assets. Starting with our people, starting with our resilience and our entrepreneurial flair and so many things that we have got. It's so easy just to listen to the noise, because I think that's maybe what you're saying as well. There's noise that can distract us from information.
Absolutely.
I'm not putting words in your mouth to say that you're saying now that the country is well priced and we should all buy it, but I just think do your homework, understand your environment, and then ignore the noise. It's an easy thing to say, and it's an incredible life lesson to learn.
Absolutely.
I really appreciate your time. I love the show. I'm sorry for giving you a hard time about being optimistic, but I think we landed on a great show. So Reza Ismail from Prescient Investment Management, he's head of bonds. They are sophisticated, savvy investors. They don't get swayed easily, and I appreciate your time. Thank you so much.
Thanks very much, Warren. It was an absolute pleasure to have chatted to you today. Thanks very much.
Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.